This is Nightly Business Report with Sue Herrera and Bill Griffith.
Market rout. The sell-off deepens. The S&P 500 closes at its 2018 low as investors grow concerned that growth is slowing in the U.S. and worldwide. Sentiment slumps. Builder confidence hits its lowest level in more than 3 years. Buyers hesitate to purchase new homes, a sharp reversal from just 1 year ago. New prognosis, a legal blow to the Affordable Care Act, is creating questions for both consumers and investors. Those stories and more tonight on Nightly Business Report for Monday, December 17th. Good evening, everyone, and welcome. Bill Griffith is off tonight. The chill on Wall Street this December deepened. The selling intensified as investors zeroed in on the idea that the economy will slow into 2019. A handful of weaker economic readings on the housing market and manufacturing came one day before the start of a two-day meeting of the Federal Reserve policymakers. The Dow Jones Industrial Average dropped 507 points to 23,592. The Nasdaq was down 156, and the S&P 500 fell 54. Right now, the S&P 500 is on pace for its second worst December ever. More than half of the stocks in the S&P are in bear market territory, meaning they're down 20% or more from their most recent highs. And the small cap index is also in a bear market. As we've been reporting, there are a lot of positives in this market, but as Mike Santoli reports, investors don't seem to care.
For the past 2 months, the stock market has been nearly immune to what has seemed like good news. Not only are U.S. employment and retail spending still strong, but several promised positive catalysts have passed without stemming the drop of more than 10% in the S&P 500. These include a third straight quarter of 20% corporate earnings growth, the resumption of aggressive share buybacks by companies in October, the passage of midterm elections with the gridlock result that Wall Street often likes, a trade truce with China, and a softer tone from the Fed on interest rate plans. This run of upbeat or hoped-for events has not been enough to rescue stocks from an overriding fear of a 2019 global slowdown, the chance that the Fed will hasten a downturn with further rate hikes, and continued uncertainty over China trade relations. Now, as Wall Street enters the final 2 weeks of trading with the S&P 500 down a few percent, the question turns to whether the market has priced in enough of the negative possibilities to find support, even if we get the feared slowdown and reduced profit expectations. Some strategists have calculated the stock market's reduced valuation is already implying something close to flat corporate profits for 2019, suggesting there may be a cushion built up already. And measures of investor sentiment are similarly showing a flare-up of anxiety that could leave the market open to pleasant surprises. Investors pulled a record amount from stock funds in the latest week, which might mean the public is already braced for tougher times. Perhaps the reaction to the Federal Reserve's interest rate decision and outlook this week will be the best signal of whether the market has worried itself into a state that leaves it primed for a relief rally that does not immediately fizzle. For Nightly Business Report, I'm Mike Santoli.
And that Fed meeting that Mike just referenced has been a focus for investors, and especially today. Over the weekend, longtime hedge fund manager Stanley Druckenmiller and former Federal Reserve Governor Kevin Warsh wrote an op-ed in the Wall Street Journal that said central bankers should not raise interest rates when they meet this week. That sentiment was echoed by White House advisor Peter Navarro.
On Wednesday, the only argument I'm hearing for the Fed to raise rates now is that somehow they have to exert their independence from the White House. Now, this is a bad argument. I think what the Fed should do is simply do what it says it's going to do, which is look at the data.
So with the Fed meeting looming and volatility on the rise, what should investors be watching? We're joined by Jeremy Bryan, portfolio manager at Gradient Investments. Jeremy, welcome. Nice to have you here.
Thanks for having me.
Let me pick up on what Mr. Navarro said earlier. There are those people on Wall Street who feel as though the market is concerned about the Fed's independence. And as a result of that, it almost forces them to maintain their independence by raising interest rates this week. What do you think of that argument?
Yeah, there's an argument to be made there. I think the bigger component is that we haven't had a dramatic deceleration in economic data yet. So I think the Fed is going to stay the course for the December rate hike. I think the probabilities out there are probably fairly accurate. What may change is what the 2019 outlook looks like and the conversations that may come as a result of that. If they change course in just the sentiment for 2019's outlook, that may give the market a little bit more of a relief rally as a result.
The other big fundamental factor that's looming large is the possibility of a government shutdown, which has created volatility in this market this last week and also today as well. How much of a possible shutdown is factored into this market already?
Sure. I think the market's digesting at least the threat of a shutdown. At this point, we don't have anything concrete. But what we do have that's different is we have a Democratic House that's coming into play. And that's a different dynamic than we've had since 2016. So it will be an interesting dynamic to see where the market shakes out from that. I think if we have a small shutdown, the market can digest that okay. I think if we start to see worsening rhetoric around it or a prolonged shutdown, that's something the market quite isn't ready for yet.
It's kind of difficult for longer-term investors to take a look at their portfolio and try and rebalance when you have a market that goes from up 46 to down 507. But I think that's what you think they should do, is take a look at their game plan, correct?
That's exactly right. What we're assessing here at Gradient is just reassessing and rebalancing. That's the biggest component that you can do right now. So if you have gains and you have stocks that you can trim gains from, there's not a lot, being that most asset classes are down this year. But if you have some and you might want to make a trim here and there, that's absolutely fine. What else you might want to do is if you have taxable accounts, it might be a good time to think about doing some tax rebalancing and taking some of those tax losses, especially for companies that you don't want to be involved with longer term any longer.
And that's if you're an active investor. But what about passive investing? Jeffrey Gundlach today of Double Line Capital gave an interview to CNBC, which produces this program, and he made some comments on passive investing. He kind of took a swipe at it. Here's what he had to say.
I think passive investing is a mania, or reached mania status, as we went into the peak of the global stock market and U.S. stock market. I think, in fact, that passive investing and robo-advisors, which I think tie together, are going to exacerbate the problems in the market because it's hurting behavior.
What do you think of that statement?
Yeah, my stance is honestly there's not much thing as passive investing. I think you need to know what you own, whether you own ETFs or whether you own individual stocks. You need to understand what those ETFs in your portfolio are for. If you own an S&P 500 ETF, you need to understand you own 500 U.S. companies, and you need to know what that means for your portfolio. So that's the way we think about it from our perspective at Gradient, is understanding what you own and investing in that regard.
All right. On that note, Jeremy, thank you very much. Jeremy Bryant,
thank you very
with
much.
Gradient Investments. And now to that weaker economic data that we mentioned at the top of the program. The New York Regional Manufacturing Index slumped to a 19-month low. Factories in the Empire State reported a sharp slowdown in business. New orders fell along with shipments. Economists say this latest report adds to the signs that the U.S. economic growth is indeed moderating. And sentiment is also down in the home building industry. A new report puts confidence at its weakest level in 3.5 years. Home builder stocks, however, finished mixed on the hopes that the central bank will halt those rate hikes. But that doesn't erase the downbeat mood in the sector. Diana Olick has the details.
The expectation was that the recent drop in mortgage rates would boost builder confidence a little, but that did not happen. Homebuilder sentiment dropped 4 points in December to 56, the lowest level since May of 2015, and a steep drop from 74 just 1 year ago. This according to the National Association of Home Builders. Anything above 50, though, is considered positive sentiment, but it's all about affordability, which is still very weak despite the pullback in mortgage rates. Home prices are just too high. NAHB Chairman Randy Knoll said in the release, "We are hearing from builders that consumer demand exists, but that customers are hesitating to make a purchase because of rising home costs." Of the index's three components, current sales conditions fell the most, down 6 points. Sales expectations in the next 6 months dropped 4 points, and buyer traffic through new homes fell 2 points. Regionally, sentiment fell hardest in the Northeast and West, where home prices are highest, but it was down across the nation. Tomorrow morning, we get a read on housing starts, which have been weak for several months. For Nightly Business Report, I'm Diana Olick in Washington.
Johnson & Johnson announced a $5 billion share repurchase program. The company also reaffirmed its 2018 sales and adjusted earnings per share guidance. This after the stock fell sharply on a report of asbestos in its baby powder, something we told you about on Friday. In an interview today with CNBC's Mad Money, CEO Alex Gorsky responded to the allegations.
I would start by saying that we unequivocally believe that our talc, our baby powder, does not contain asbestos. And that's demonstrated in thousands of studies not only conducted by Johnson & Johnson, but studies conducted by independent authorities, well-respected authorities, where we work closely with regulators who are overlooking the methodology. And by the way, throughout this process, we also not only use the best testing methodologies that were available, but we continue to improve them through the years.
Shares fell nearly 3% today, adding to the 10% decline of Friday. Goldman Sachs found itself where no company wants to be. It is tangled up in a corruption scandal. The scandal is in Malaysia, and now that country is filing criminal charges. That sent the stock down more than 2.5%. Wilfred Frost has the details.
Goldman Sachs was dealt another blow in the scandal it has been trying to contain. Malaysia prosecutors filed criminal charges against the bank and two former employees, saying they committed, quote, gross violations of the country's securities laws. This all relates to a bond issuance in 2012 and 2013 that saw Goldman Sachs help the Malaysian sovereign wealth fund, 1MDB, raise $6.5 billion, some of which was later siphoned off fraudulently by 1MDB employees. The Malaysian Attorney General says that Goldman Sachs had to be held accountable and is seeking fines worth over $3 billion. The U.S. Department of Justice is also investigating the issue. Goldman Sachs responded today and said, quote, we believe these charges are misdirected. We'll vigorously defend against them and look forward to the opportunity to present our case. The firm continues to cooperate with all authorities investigating these matters. They added, quote, that certain members of the former Malaysian government and 1MDB lied to Goldman Sachs. The stock has fallen sharply in recent months on news of these investigations, down nearly 27% since early November, losing nearly $15 billion in market cap. Investors not only fearful of a large fine, but possible loss of revenue for Goldman, and more importantly, possible rising costs from a need to improve internal functions. This is the first time Goldman has faced criminal charges on the case, but neither Malaysian nor US Justice Departments have so far suggested Goldman's involvement was intentional. For Nightly Business Report, I'm Wilfred Frost in New York.
It is time to take a look at some of today's upgrades and downgrades. Best Buy was downgraded to underperform from neutral at Bank of America Merrill Lynch. The analyst cites slowing sales of TVs and iPhones. The price target, $50. The stock fell more than 5.5% to $52.23. Lululemon was upgraded to buy from hold at Stifel Nicolaus. The analyst there cites the potential for double-digit revenue growth. The price target is $151. The stock fell a fraction along with the broader market today to $118.87. And Stanley Black & Decker was upgraded to buy from hold at Deutsche Bank. The analyst likes the company's fundamentals and is less concerned about the possible impact of tariffs. The price target is $143. The stock rose more than 1% to $119.98. Still ahead, the market turmoil doesn't appear to be slowing down online shopping.
Today is one of the busiest of the holiday season for FedEx. The company expects to break its record for holiday deliveries. Coming up, I'll show you how e-commerce is the driving force.
Oil prices settled below $50 a barrel for the first time since October of last year. The market is concerned about an oversupply in the U.S. This after industry data showed inventories at the storage hub at Cushing, Oklahoma, rose by more than 1 million barrels. Add to that, worries about global demand and domestic crude settled down about 2.5%. CEO confidence has fallen to a 2-year low. A new survey says chief executives are growing concerned about a cooling economy, rising interest rates, and uncertainty related to trade with China. The survey also cited corporate debt levels as a developing concern, especially if the Fed continues to hike rates. It was a rough day for healthcare stocks. The sector was pressured not just by the broad market sell-off, but also by a legal ruling late Friday that said the Affordable Care Act, or the ACA, was unconstitutional. Insurers Molina and Centene have the highest exposure to the ACA. Hospital stocks also fell. So what happens next for the industry given the ruling? Mary Agnes Carey covers healthcare for Kaiser Health News, and she joins us now. Mary Agnes, welcome. Nice to have you here.
Thank you.
It was a shock for the market, partly because of the timing of this ruling. It came late Friday night, Eastern time, and so the market only had today to react to it. But in essence, what does this change, if anything at all?
Right now, it doesn't change a thing. Insurers that have had they're part of the Affordable Care Act marketplace, they're still in place for 2019. Consumers on the federal exchanges, as you note, had through Friday midnight to enroll. Some states like California have a longer enrollment period. So everything is in place for 2019. But of course, another legal challenge to the Affordable Care Act just creates uncertainty for a lot of companies.
And a lot of people
and
as well.
And a lot of consumers as well, exactly.
So, and it is millions of people. Can you put it in context for us? How many people use the Affordable Care Act?
Sure, about 20 million people have newly found coverage on the Affordable Care Act, either at the exchanges or in the marketplaces. But for millions of other Americans that might get their health care through work, the idea that their pre-existing medical conditions, they will still be covered, is incredibly important. There's also no more lifetime or annual limits and no cost sharing on preventive services, and for some Americans, a more comprehensive package of benefits. So all that is thrown into question with this legal challenge.
And do you view an appeal in the offing?
Oh, absolutely. There's some other matters in this particular Texas case that need to be settled with the judge in early January, but there will be an appeal to the appeals court for the Fifth Circuit, and some analysts expect this to go all the way to the Supreme Court.
Now, what will that do basically to those industries involved? Because they have choices as to whether or not they want exposure to the Affordable Care Act. We mentioned Centene and Molina. Do they make business decisions based on the idea that it is going to be appealed, or do they just stay the course and see what plays out?
I think for now they would stay the course, but as you look to when the firms need to put in their bids for 2020, for example, by that point in time, will the appeals court have heard and ruled on this particular ruling? And if they have, are there any signals at that point of whether or not it's going to the Supreme Court and when? So I think for now people will hold, but as they look towards the next enrollment season for 2020, it could have some impact.
Mary Agnes Carey, thank you so much.
Sure, thank you.
Mary Agnes is with Kaiser Health News. Well, the cloud helps lift Oracle's bottom line. That's where we begin tonight's market focus. The company reported better than expected earnings and revenue. It added more clients to its cloud services and license support division, which is its biggest business unit. Hardware revenue was, however, a little shy of estimates. But in general, it helped lift the stock in the initial after-hours trading. Shares fell during the regular session to $45.73. Boeing is increasing its dividend by 20% to $2.05 a share. The Dow component also announced a $20 billion buyback program, and that is up from $18 billion that it approved last December. That lifted the stock in initial after-hours trading. It finished the regular session down just a fraction to $316.13. Jack in the Box apparently looking into selling itself. The restaurant chain has seen lower sales and operating earnings and says it talked to buyers about a potential sale. The board, though, did not lay out a timetable. The stock rose 2% to $82.03. And California regulators late Friday said that PG&E falsified natural gas pipeline safety records for years. An inspection found that the utility company did not have sufficient staff to fulfill required inspections, and it pressured employees to complete the work. PG&E says it is taking actions in response to the findings. The shares fell 6% to $24.44. Today is one of the busiest days for FedEx this holiday season. The shipping company expects to break records and process more packages than ever. Frank Holland takes us behind the scenes at a facility in Edison, New Jersey.
The e-commerce boom has this FedEx facility busier than it's ever been.
It's a huge impact on the holiday shipping season, but it's also a year-round phenomenon.
The company predicting it will deliver more than 400 million parcels, packages, and other products between Thanksgiving and Christmas, breaking its record from 2017.
The volumes and the peak season, they start to accelerate earlier and earlier every year as e-commerce grows.
UPS and the post office are also expecting to ship a record amount this holiday season. For Thanksgiving week, Cyber Week, and the week after, all three getting high marks for on-time delivery. FedEx at 95%. The average for the rest of the year is about 98%.
It's definitely growing. We're able to handle the volume. We're looking at different new ways to automate our processes to handle more of that volume.
This automated facility in Edison, New Jersey was built in 2016 in response to the e-commerce explosion. FedEx says the automation you see here helps the company handle more volume and deliver even bigger packages.
We have about 80% of our volume, we'll say in the middle of the package size spectrum that goes through the automated systems. But now this time of year with e-commerce, really the ends of the spectrum really change. With the smallest packages, that volume increases. And then on the other side, the largest packages, that volume increases as well. So think of things like tires and trampolines and small furniture comes through our facility, especially even higher this time of year.
Last quarter, FedEx saw the amount of packages it handles on an average day increase by 3%. Analysts expect that trend to continue. FedEx expects more and more orders that can't fit under a Christmas tree. That requires a more flexible supply chain. Management says automation is a key to that goal.
It allows us to be flexible. We can ramp up, ramp down. It allows us to move volume around the network in different ways. During this time of year especially, we have surges that happen from our customers.
For Nightly Business Report, I'm Frank Holland in Edison, New Jersey.
FedEx reports its quarterly results tomorrow, and investors are hoping to hear more about its delivery business. Coming up, why the future of retail may be cashierless. CBS's board of directors concluded its investigation into former CEO Les Moonves and cultural issues at the network. It found that harassment and retaliation are not pervasive, but that diversity and inclusion initiatives are, quote, inadequate. It also said that Moonves will not receive a $120 million severance payment. Google is providing details of its expansion into New York City. The company plans to spend more than $1 billion in Lower Manhattan as part of a project that could add more than 7,000 workers, which would double the current number in the city. Google opened its first office in New York 20 years ago. California has abandoned its plans to tax text messages. Regulators say a new FCC ruling prevented the state from levying the tax because it reclassified texts. The money raised would have gone to fund programs that bring connectivity to underserved residents. The tax had been opposed by consumers and the wireless industry. The holiday shopping season is entering the home stretch. And one big theme that has emerged this year is high-tech convenience, especially at the checkout. Courtney Reagan is in Dallas tonight.
Time is running short to finish your shopping. But a store with no true checkout may improve your frantic experience. At least that's what retailers like Sam's Club is hoping. This new Sam's Club Now is a store and technology lab in one, where the Walmart-owned wholesale retailer can test different technologies before deciding which to go with. Scan & Go has been available as one checkout option for Sam's shoppers for a couple years, but it's the only way to check out here. There are no registers. Sam's Club says the Scan & Go checkout hasn't eliminated jobs, just repositioned what the employees do at the store. A member host helps shoppers sign up with the app for the first time, which takes about 2 minutes. Then they're ready to shop. You simply scan items as you go and load up your cart. Then at the exit, you scan a QR code on your phone as you go.
We've had great member feedback for almost 3 years now with Scan and Go. It's one of these applications, the rare ones you get where people tell you they love the product, they love the time it saves them, the ratings are high, the reusage rates are high, and it's over 40% just over a year ago.
At Amazon's 7 Amazon Go stores, shoppers don't have to scan the products. Just scan in with the app when entering the store, shop normally, and walk out. Cameras and sensors detect the items in the cart and charge you once you leave. While Sam's and Amazon built their own systems, Standard Cognition sells cashierless technology to retailers like grocery, drug, and convenience stores in Japan, the UK, and the US. Like Amazon Go, shoppers check in with an app, cameras detect the purchases, and charge the connected account automatically. None of these companies are disclosing the cost of the technology, but Standard Cognition says in the long run, it's less than the cost of traditional checkout. But like all technology, there are bugs that need worked out, and it's not always perfect. But Sam's Club says that's all part of the reason for testing at this one unique store. For Nightly Business Report, I'm Courtney Reagan in Dallas, Texas.
Here's another look at the final numbers on Wall Street. The Dow dropped 507 points, the Nasdaq was down 156, and the S&P 500 fell 54. That does it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us. Have a great evening. We'll see you tomorrow.